Challenges for British economy. Britain has emerged from the pandemic with most economic indicators flashing red. The prospects for the UK economy have weakened this year and next in response to the Russian invasion of Ukraine, a messy divorce process from the EU that remains unresolved, and global supply chain blockages hitting many business sectors. Following Boris Johnson's departure, a new government will need to release itself from former Chancellor Rishi Sunak's spending constraints to ease the inflationary pressures on households while preventing a possible slide into recession with extra support for businesses. Here are the main economic issues ministers will need to confront. Inflation. The Consumer Prices Index has jumped from almost zero during the pandemic to 9.1% and is forecast to top 11% by October, when rising energy prices push average combined gas and electricity bills above £2,800 a year. Most economists believe the growth in prices will ease next year, but their forecasts depend on the war in Ukraine ending. Brent crude almost doubled in price to $128 a barrel in the year before Russia's invasion of Ukraine, before slipping back. GDP. Britain suffered the biggest fall in national income, GDP, since the early 18th century, when the economy was mothballed in April 2020. It bounced back rapidly, but the recovery slowed this year as the global economy began to stutter. The UK imports more than half its food and the majority of its gas and oil, making it especially vulnerable to global shocks. The next official figures for GDP, for May, are expected to show a third consecutive month of contraction. The UK economy is only 0.9% bigger than it was in November 2019. Tax burden. Ministers face pressure from backbench Tory MPs to reverse the Johnson administration's plans to increase taxes on businesses and households over the rest of the parliament to pay for spending during the pandemic. However, the scope for tax cuts is limited, especially when many Conservatives are also urging the government to increase the defense budget in the face of the renewed threat from Russia. The likelihood of further economic shocks and an aging population will further add to calls for extra cash from the exchequer. UK trade. France and Britain have tracked each other for decades in charts showing the value of trade as a percentage of GDP. The global post-pandemic recovery last year lifted all boats. However, recent figures have shown Britain's trade stagnated while France's position has improved dramatically. Brexit is blamed by many economists for the UK's less rosy outlook. In its latest assessment, the Institute of Export and International Trade said total export revenues dropped across the UK by 2% from the previous month, highlighting the struggles businesses are facing as a result of the pandemic, supply chain crisis, Russia-Ukraine conflict, and Brexit. UK workforce. Official estimates show the UK has about 1.2 million fewer workers in 2022 than was expected in 2019. Many EU workers returned home during the pandemic. Older workers took early retirement and tens of thousands of students returned to education. David Miles, the Office for Budget Responsibility's main economic advisor, said it was likely some older workers and many students would return to the labor market, but it was reasonable to judge that the UK had suffered a permanent drop, leading to sustained labor shortages in some industries. Brexit and COVID have also combined to reduce the number of workers seeking employment, pushing up wages and hindering recovery. R&D spending. Science spending has tumbled, and a promise to increase the funds for research and development remains just that, a promise. Sunak planned to increase UK R&D spending to 2.4% of GDP, up from 1.74% last year. France already spends 2.2% of GDP, the US 3.1% and Germany 3.2%. The Chancellor initially wanted to achieve this by 2025, but earlier this year he pushed the date back to 2027. Low productivity growth. Since 2009, labor productivity has stagnated, falling considerably behind the UK's trend growth. Poor productivity is a major factor behind the very limited growth in real GDP and a flatlining of average real wages. The UK is not the only country to face a slowdown in productivity growth, but the record of the UK is one of the lowest in the G20. Reasons for low productivity growth include a lack of investment in new technology and a short-term approach from both businesses and the government. This unwillingness to invest in new technology has certainly been exacerbated by COVID disruptions, but the problem goes back to well before COVID and even before the Brexit vote. Brexit. The UK has not only left the EU, but also the single market and the customs union. This caused considerable disruption to EU trade, which in 2016 accounted for over 50% of UK trade. Firms exporting to Europe are faced with an increase in regulation, customs forms and charges for selling goods in the EU. The OBR claim the effects of Brexit will cut UK GDP by 4%. This is up to £100 billion in lost output and £40 billion less revenue to the Treasury, OBR. Another think tank Centre for European Reform, CER, models that the cost of Brexit is a shortfall in GDP of 5.2%. The row over the knee protocol has meant further problems with the EU's relationship with the UK. In retaliation, the EU has not ratified Britain's associate membership at Horizon Science funding. Further barriers to trade may occur. It was hoped Brexit would lead to liberalising trade with non-EU countries. But many trade deals are quite similar to the UK had within the EU anywhere. Also, there are definitely barriers to switching trade from your geographical neighbours to the other side of the globe. It makes sense to trade with those countries geographically the closest. High tax burden to GDP ratio. Since 1993, we have seen a sharp rise in tax burden as a share of GDP. But the problem is there isn't a strong dividend of higher public sector investment. The rising tax burden highlights the weakness of tax revenues and the need for higher government spending on COVID bailouts and also from increased spending on healthcare and welfare. The concern is that pressures on government spending will continue as we face an aging population, ongoing COVID treatments, and a cost of living crisis which puts pressure on social security spending. Post-Brexit devaluation. Since the Brexit vote in 2016, the pound has devalued by 16%, causing an increase in the cost of imports and contributing to domestic inflation. Whilst a devaluation, in theory, makes exports more competitive, there is little sign of a prolonged boost in exports. A good example of the effect of devaluation on the cost of living is how the UK is paying more for petrol. In 2008, oil reached $144 per barrel, but petrol peaked at 120p per litre. Today, the oil price is $111 but pump prices are just below 200p per litre. There are other factors behind petrol prices, such as bigger profit margins at refineries, but devaluation is still a major factor and helps to explain the high prices. Furthermore, recent political uncertainty and a record current account deficit have further weakened the value of the sterling. Current account deficit. The UK's current account deficit hit a record 8.3% of GDP in Q1 2022. This was something of an anomaly with the higher price of raw materials contributing to a record trade deficit, but even discounting this quarter, the underlying trade deficit is a cause for concern, especially since the devaluation of the pound has done little to improve the current account. The concern is that with Brexit, high inflation and low productivity growth, there is a continued lack of competitiveness with major trading partners. In the past, the UK has been able to finance the current account deficit by attracting capital flows, e.g. China, Russia, Middle East, buying UK assets and saving in UK banks. Post-Brexit, the UK has become less desirable as a destination for capital flows. If these capital flows do slow down, it will put further downward pressure on sterling. National debt. UK public sector debt has increased since 2008, and with demographic factors, the OBR predict a worst-case scenario of public sector debt of 320% of GDP within 50 years.